And some people are suggesting, as our chairman's been a little bit more circumspect, that we might have to wait towards the end of this year for the bottom to be achieved. So that would make it a 24-month. So 18 to 24 months, this is going to be the longest lived recession in our working lifetimes and many some people's lifetimes altogether. In terms of the drop in GDP, and I should put the Great Depression into this as well. Again, we have no formal distinction between a recession and a depression. There's often that adage that, it's a recession when your neighbor loses their job, but it's a depression when you lose yours. But there is no formal distinction, although some people have suggested a fall in economic activity of a magnitude of 10%. And I don't think it's a bad number to be thinking about. But during the Great Depression, we didn't see a 24-month drop in economic activity. The economy declined for 43 consecutive months during the 1930s at one stretch. In terms of the drop of GDP, we're looking at a drop that averages about 1.7%. Doesn't sound like a lot, but again, given the fact that we should be growing for that year of the recession, we really should have been adding about 2.5 to 2.75%. You can add that to what we didn't accomplish, to the loss that occurred, and there you can see it's a much larger drop than what you would normally think about. But the range has been between minus 0.4 and a minus 3.1%. Taking the forecast for the second quarter, which is still expected to be down, but not as deep by any means as the first quarter, and that's the other thing I should also talk about, is you see these pundits who will talk about the fact that, yes, the declines are slowing, but we're still falling. Well, something, the reality is that it's not like an economy falls at a 6% rate and then stops on a dime. We're not some Formula One race car with these great brakes. It tends to that certain industries will begin to recover earlier versus others, so we tend to see this moderation of activity that leads us into the bottoming of a business cycle. With this one here, with the forecast for the second quarter of that drop of just under 2% being forecast, would lead us with a decline of minus 3.6% from its peak in the second quarter of last year. So this would be the deepest as well drop in economic activity. The Great Depression, economic activity fell 26%. So when people, again, kind of talk about and make comparisons to what we're experiencing now to what was happening during the 1930s, we're not even in the same city, let alone the same ballpark, in making those kind of comparisons. I mean, things were really horrible back then. In terms of unemployment rates, averages about 7.8% in the last 50 years, with as you can see, a range of up to 10.8% that occurred in the 1980s. Right now, this group is forecasting a peak of unemployment at 9.9%, which actually, given the natural rate, has been lowered because of technology, such as all these job search engines that exist. We view that as being about a percentage point lower than it was back in 1980. So actually, the growth, the unemployment rate that we're talking about now is about equal to as bad as it was during the 1980s. In terms of, and by the way, the unemployment rate during the Great Depression was at 25%. So again, significantly different. And then in terms of the drop of employment, normally we lose just over 2% of our workforce, with a range of, again, as deep as a little over 3%. Here, the economy has been very hard hit, with 6 million jobs being shed at this point in time, and already that would amount to 4.3% drop. So these drops will continue. We really don't get back up to trend growth until next year. And therefore, we're going to, until you get to trend growth, you can pretty much anticipate that you're going to see job losses continue, although the rate of job loss will be moderating. So, question I ask you is, do you believe that this recession will be over by the middle of this year? And I think you've got a chance to use those clickers. So it's 1 if you believe middle of this year, we'll be looking at a bottom, and 2 otherwise. Okay, so a little pessimism in the room. That's okay. That's not unusual. I'll talk more about manufacturing. In fact, at an industrial, so here I'm going to ask you, do you think it'll happen by the end of the year? And then I'll tell you my little story about my roundtable. Yeah, in February, I asked this question to our roundtable group. About 25 manufacturers were in attendance, and at that time, Blue Chip was again forecasting a bottom around mid-year. They haven't changed their view on that in the subsequent months. And the view was that, well, nobody in the room, nobody of the roughly 25 people in attendance thought that we would bottom mid-year. I just had one last month, and in fact, it was roughly in line with what you guys were talking about. There were some, but not majority. But most of you, again, think that it will come to an end at least some point during this year. Although, again, 25%, 1 out of 4 of you, are suggesting that we'll have to wait even into next year. So some things to think about is that, we produce at the Chicago Fed an index known as the National Activity Index, and that has been down quite deep, and it has fallen below a range of roughly minus 0.7 to a minus 1.3, and that's usually indicative of weakness where we talk about a recession. So we are below this recessionary level, but as you can see, we're approaching it very rapidly. In addition to that, consumer confidence has begun to bounce back up. I'm not a big fan of consumer confidence measurements, but I throw that out just as another sign of what's happening. With regard to inflation, inflation measurements, which had been rising quite significantly, as all of you were experiencing on materials costs and so forth, early part of last year, that has reversed itself. Nothing exhibits that better than what was happening to oil prices, which reached a peak in the summer of last year at $147 a barrel on a daily rate. By the end of the year, that was below $50. Anybody in this room think you would see oil below $50 a barrel at the end of during last summer? That would occur? Yeah. If you could have probably bought this hotel if you would have believed that, because you could have made a lot of money on the short. But as you can see, oil prices, which had collapsed down to $35 a barrel in January, have more than doubled. They're up over $70 today. And actually, that's good news, bad news on all of this. The fact that energy prices have scaled back is great for manufacturers who are heavy users of energy. It's great for consumers, which spend a lot of money on filling up their vehicles and paying gas bills and electric bills and so forth. But the fact is that the reason why it got down to $35 a barrel was because of a collapse of demand. The fact that it's up over 70 is because demand is coming back. And if you want to have the economy end its recession, you got to have demand come back, and that certainly is a good indicator of that. But this chart, that previous chart, was a good way of a very famous quote from Benjamin Disraeli, the British Prime Minister from the 1800s, who said that there are 3 types of lies. You have your lies, you have your damn lies, and you have statistics. Because by showing you a chart where I'm giving you the nominal price of oil shows that in 1980 it was about $40 a barrel, and look at it, last year it was more than 3 times that amount. But of course, $1 in 1980 is not equivalent to $1 today. Once we adjust for inflation, what we find out is that today's energy prices are quite high, but relative to what an adjusted price was for 1980, that was over $100 a barrel back then. So, in fact, this has averaged out to just over or just under 1% a year on energy prices. And as you can see, our current level, even at $70 a barrel, is well below where we were back during those peaks. And, even last summer, I was not concerned, even at $4 a gallon gasoline or $140 a barrel oil, I wasn't concerned that this was going to be enough to kick us into a recession. It wasn't helping, but it just wasn't enough, because when you look at the percentage of consumers, which represent 2/3 of our economy, their spending dollars, even at the peak of last summer, they were spending about 7 cents out of every dollar they spent on filling up their Hummers and paying the gas bill, the electric bill. From a historical perspective, it just wasn't that large.